Hello and welcome to our special show, Outlook 2025. Joining us today are some very special guests. We have with us Jonathan Garner, Chief Asia and Emerging Markets Equity Strategist at Morgan Stanley. Jonathan, welcome to this special conversation. And we have been in the midst of a time where there's been a FPI exodus of sorts from India. The market's been correcting. So the first question to you is, do you think the FPI selling is going to continue, at least in the near term?
The Indian market has been outperforming other EM quite dramatically in the last 3 or 4 years, and particularly outperforming China. And so what's happening is the weight of India in the EM index has actually been going up. And with the domestic bid very strong, valuations are relatively elevated. I wouldn't say they're extreme, but they're relatively elevated. And so what you're seeing actually is that the selling that foreigners are doing is just simply about that maintaining a quite large holding in India into a market that has been performing well. It's not some kind of problem that's going on here. It's actually a problem of success. And if we're right, our target for Sensex is 93,000. We're overweight the market. We're well above consensus on earnings growth. We expect foreigners to be very engaged in the Indian market this year. Over time, it's on its way to being the largest market in EM. And that means global investors are going to pay a lot more attention to India than they have in the past. And we see that a lot, being asked to arrange the first investor trips for global investors who really haven't looked at India historically. Historically, it's obviously been large within the EM bucket, but not for global investors. So it's quite a complicated situation that's unfolding.
So just to complete that point, and you look at this data very closely, so India's weight in MSCI Asia ex Japan is about just under 20%. FII ownership of India is now, I mean, there's a significant underweight, right? Relative to that 19.8, I think should be closer to 16%, Jonathan? I mean, what's the number now? And
it's actually quite close to benchmark weight, but I think the reason that you're so aware of this, let's say, and people in India are aware of it, is that if you go back a decade ago, global EM investors were double weighted India. Double weighted. In other words, they realized that India was about to do very well, which is what we've seen. So this is this selling into strength story that I'm trying to get across to you within the EM investor group. But what has yet to take place, and we're so excited about, is truly global investors. Now these stocks are so large. We think about names like Reliance Industries or ICICI Bank, those two like mega caps, names we tend to like, they stand a chance of finding their way into global portfolios, which is a much, much larger superset, the entire global equities universe. And if you think about the US, that's ballpark, let's say 75% of all country world index, India's knocking on the door of around 2% now at a global level. Okay, so 2% of global equities. Once it gets to 3 or 4%, you can't ignore it anymore as a global investor.
What will get that FPI interest back? Because they've just been rushing to the exit door, not checking anything. Are valuations still the biggest sort of impediment? Is it growth? When earnings revive, is that when you expect the buying to return?
Yeah, again, I wouldn't describe it as rushing to the exit door at all. I mean, if you look, for example, at market that performed very poorly, that's also a large EM market last year, Korea, the Indian market dramatically outperformed the Korean market last year. So you have to look at the totality of the situation. But to try to be looking forward here, what's important, I think, is that GDP growth is over 6%. We're forecasting 6.3% and then 6.5% this year and next, the year ending March and then the following year. That inflation remains moderate, a little over 4%. The interest rates, we get 2 rate cuts in our view, and that we get this kind of compounding of earnings at 15 to 20% per annum in rupee, which the market is able to do, way above earnings growth everywhere else. And as that happens, India will continue to rise in the EM index, in the global equities indices. It'll continue to outperform. And the domestic bid is going to remain strong. And as I've said, at the margin, we're going to get a different type of investor in India, the truly global investor, rather than just the dedicated EM investor.
The earnings, Jonathan, that's what really stands out, because you folks have remained with the earnings projections being rock steady, like you said,
Yes.
15 to 20% compounding earnings. A lot of people here, domestic sort of, money managers also are kind of questioning that, at least in the near term. So do you see
Yes,
this whole debate around a slowdown in India? I mean, how do you view it from your standpoint?
We're well aware of that and have written extensively on it, and we think it's a 2 to 3 quarter phenomenon. If we're wrong, if it's a 2 to 3 year phenomenon and earnings growth falls away substantially, then our call on the market will be wrong. But we don't think we are. So our colleague Ridham and then Upasana, who's our economist, fairly sure that they've identified the cyclical factors behind the downturn late last year. And, next up is, of course, the budget, where we expect the primary deficit essentially to be set around 0. And I do think that with the strength of the US dollar and the uncertainty over the Trump administration, that will gradually resolve itself. And as it does, I think it'll be dramatically in India's favor relative to some of the other markets we cover, most notably China. India has a lot of optionality in the Trump administration, which some other large EM geographies lack.
Jonathan, you gave us your upside target on the Sensex. I think that's close to around 18% away from current levels post the recent correction. On the downside, what do you think? At worst case, do you expect the markets to pull back maybe 10% from here at worst?
Well, we always publish bull, base, bear targets. I don't have the bear case right in front of me at the moment, but I would say that you could expect in a scenario where, for example, the S&P 500 enters into a bear market, some kind of early US recession, then you would get that kind of decline and maybe even larger than that. But I would say that at the moment, we're quite confident in the base case forecast that we have. I mean, bear in mind, the backup in yields in the US is to some extent because nominal GDP growth remains very strong in the US.
Okay.
And though the Indian market is not as correlated with the US as in the past, ultimately, all markets have some degree of correlation to the US market.
Jonathan, slightly pulling back a little bit, right? Bringing in the new incoming sort of president and the implications of that. You guys at Morgan Stanley over the years have published a fair bit about how we're moving to a multipolar world, etc. For an economy like India, I mean, we export very little to the US. Services, of course, aside. Import, in terms of from the US. So in that sense, we're kind of insulated, all this tariff talk, etc. Not completely. There will be some effects, or second order, third order. But on the external side, does India, is 2025 to you looking a lot more adversarial? Or you think one should kind of keep that aside?
Yeah, we've made multipolar world yet again a key theme for the year at Morgan Stanley, and you are going to see a slew of tariff and non-tariff actions, and that's going to be an issue for the more trade-dependent and US-exposed markets in Asia. We actually have a theme of liking domestic demand in places like India and Southeast Asia that are more like ring-fenced from that and more influenced by underlying domestic economic growth. And so that's an advantage. However, all that said, one other aspect of multipolar world dynamics is that corporates are relocating manufacturing out of China, and India's benefiting from that, and private equity and portfolio equities, but particularly private equity flows, are much more diversified than they used to be. And there is a boom in private equity interest in Japan and also in India. And so actually within the multipolar world framework, we often make the point that India is probably the most advantaged geography, the way that things are panning out between the US and China in particular.
Okay, all right. Just quickly, final word. We're approaching the budget. You are extremely optimistic on the economy and the markets here, Jonathan. What are you expecting from the RBI over the course of the next couple of months? And would you want to see anything more decisive by the government? Your budget expectations or recommendations for India?
Well, to some extent, monetary policy tightened, arguably, from the mid-year last year. We think some gradual easing is appropriate, but obviously that depends on the inflation outlook. And then on the budget side, we'll see, but there's been a very big focus on capital expenditure and infrastructure delivery. Maybe there's some opportunity to loosen elsewhere. We are in a cyclical slowdown in India, but India has plenty of firepower on the monetary and fiscal side to lean into that cyclical slowdown. So it's not something to be concerned about.
Got that, Jonathan. Appreciate your views. Thank you very much for taking out the time, and we look forward to more conversations during the course of the year. With that, we need to take a very quick break. On the other side, we'll have with us a view from JPMorgan. Jahangir Aziz, Head Emerging Market Economic Research at JPMorgan, joins in to talk about the increase in higher tariffs and the currency conundrum that we seem to be in the midst of.
from sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Jahangir, good to have you with us here. Thank you very much for your time. I don't know if you saw, but incoming President Trump has posted on the social media platform Truth Social. He's saying that, well, there is the Internal Revenue Service in the US collecting taxes from Americans. He's going to create the External Revenue Service, and it's going to come alive on the 20th of January, responsible for keeping tabs on tariffs and who owes how much to Americans, and essentially, collection agency from the outside, for the outside world. Maybe it's kind of what we're seeing now, and till the 20th of January is kind of peak Trump, and things perhaps will settle down once he actually is in office. Is that too much of a stretch to expect, Jahangir, or you think it's possible?
Look, the way we are looking at we've been tracking this since, the election was over, and, it is possible that President Trump comes out to be very different from his rhetoric during the campaign. I'm neither brave nor imaginative enough to try and second guess President Trump. So we are taking him literally. And as far as taking him literally is concerned, we think that the tariffs and immigration will be changed dramatically. And then later on, both tax policies and deregulation. So on tariffs, our view is that China and Malaysia and Vietnam, through which Chinese transshipment goes through, will be targeted. We had 60% tariff on China, so China and tariff is 20% at present. We expected it to go to 60%. Why 60%? That's because President Trump, during his campaign, mentioned 60% several times. As I said, we are going to take him literally, and not try and second guess. I think the news reports, etc., that has come since the election suggests that that may not be the only objective of the tariffs. Tariffs could also be driven by the objective of raising revenue, such that the tax cuts that he is proposing can be funded. Now, if that's the case, then our sense is that on January 20th or that week of 20th, you're probably going to get many, many more countries under the tariff umbrella than just China and Malaysia and Vietnam.
Okay, Jahangir. So
we just one thing. Jahangir, you're saying that Chinese imports will be tariffed at 60%. I just wanted to make that clear. So
that's a baseline. That's a baseline. Its current effective rate is 20%. We expect 20% to go to 60%. But as I said, that was our view back probably in December. I think the news flow since December suggests that perhaps it may not be 60%, maybe a tad less. But many other countries will be brought under that tariff umbrella. So tariff will be imposed on many of the countries, simply because that's the only way in which you can actually raise any reasonable revenue.
And you're saying other countries may also see these countries, especially from where China was using as points from where to send things into the US to avoid this tariff, right? Mexico, etc.
That was Malaysia, Vietnam.
Okay.
So this is going to be, our suspicion is that if you're going to raise revenues, you have to now impose tariffs on countries which were seen to be alternatives to China. You need to block that off. And therefore, many more countries will be brought under the element.
So Jahangir, I mean, I'm hearing you loud and clear. You're not in the camp that's expecting that, this will ease out, and maybe it's all been rhetoric and more a bark than a bite. Take your point, take your caution on board. But my question is that hasn't much of this, even if it plays out literally as what he's been saying, Hasn't this been priced into the market with the dollar rushing to 110? I mean, have we already seen the worst of the market interpretation in the mayhem?
Really?
There's more to go.
I mean, you can at best take dollar euro, for example, or DXY. You at best can get about 6-7% of tariffs being priced in. That's it.
Oh.
6-7% of tariffs is, I mean, any kind of FX arithmetic, if you break it down between the growth differential between US and the rest of the world, the interest rate differential, even after, especially after the change in the Fed call that we have done after the non-farm payroll came out last week. If you take those two factors, which are the usual drivers of dollar strength, at best you can say that the market is pricing in maybe 6-7% of tariff increase. That's the extreme.
Oof.
The 6-7%
Tariffs could easily be significant.
On what? China? On China? On China?
No, the average effective
tariff increase.
Tariff increase by the US. So the tariff right now is about 2.3%. Right? So 2.3%, you add about 6-7%. That's about all that the dollar is pricing in this point in time. It could easily be significantly larger than that.
What is the average overall increase that you're expecting, taking him literally, taking Donald Trump at face value at what he's been saying? And how much more than for the dollar to go? I mean, 115 more? The DXY.
I mean, you can easily add another 10 to 20% tariffs on the rest of the world. So 10 to 20% tariff on the rest of the world, that's the number that he's talked about, along with maybe not 60% of tariff on China, maybe slightly less tariff on China. That could well be what we see in next week.
Okay.
So what does it mean for the dollar then?
Index,
the DXY?
I don't think any of my strategists are willing to price that.
Okay.
All right, Jahangir.
These are scary numbers.
I can
Obviously,
imagine.
nobody's going to price.
Indeed. Let's look home at our own currency then. The Indian rupee has weakened. We are at around that 86, 87 odd. Many were projecting by the end of this year we'll be at 87, 88. We're already there. We're 15 days into the calendar year. What happens to the Indian rupee? If you could, tell us how do you see that move? And also, what are you pricing with regard to the RBI, Jahangir? Because earlier we were factoring that maybe in February we see some kind of action, which could get pushed back a little bit. Your take?
Yes. So I think, there are two parts to it, right? The one part of it is that the real effective exchange in India has gone up significantly over the last 2 years. So there is the need for the exchange rate to depreciate in order to bring back the real exchange rate back to more normal levels. So that's one driver of that. Obviously, oil prices, current account deficit, etc., are the other driver. The outflow of foreign portfolio outflows is the other driver. But I think that in the event we do get these kinds of tariffs being imposed, we really don't know what it is. If you go literally by what President Trump has said, it is going to be a pretty large number of pretty high rate on the rest of the world as well as on China. So it would what happens in the Indian rupee depends almost entirely how dollar CNY reacts. If dollar CNY reacts by, let's say, depreciating another 5% or more from here onwards, then the rupee is appreciated even more against its biggest trading partner, which means the real effective exchange rate gets appreciated even further, making the need for a nominal depreciation even that much greater. Therefore, the pressure on the rupee to depreciate becomes even greater.
Right.
So I won't be able to tell you what the number is, but that is the direction of travel.
So, I mean, if tariffs on Chinese imports are not 60, but even 40, whatever, I mean, dollar CNY goes to 8, and then currency here in India, which also, I mean, I think, as you say, depreciates, right? Will have to.
That's correct.
Just a couple of things I wanted to clarify, Jahangir, if you can. One is, there was a report which said that, and there was no pushback to it. Usually, I mean, press reports something and Trump tweets or something and says, well, this is all rubbish. But there was this report which said that gradual tariff increases, not at one go.
Right.
If that were to, so far 48 hours we've not seen any pushback. If that were the way it is implemented, do you think that is more desirable?
I mean, look, it depends on what is the objective, right? If the objective is, I'm going to use euphemism over here, to improve U.S. competitiveness, right? Then you can talk about a gradual increase in tariffs. You negotiate, things from the other side so that U.S. competitiveness, quote unquote, improves, right? If that's the sole reason, which was the reason as to why we said only China and the transshipments through Vietnam and Malaysia would be targeted. But if the objective is to raise revenue, then then there is no real negotiation. Right?
Yeah.
Then there is no reason for you to have a, sliding scale.
Yeah.
You want $250 billion of tariffs. U.S. imports is about 3.6 trillion. To get that, you need a tariff rate pretty much around that, 8, 9, 10% rate. And I'm talking about the average effective tariff.
Got it.
Now, how you distribute that across China, across other countries, that's a matter of choice.
Got it. Now, let's talk about impact on, say, tariffs go up. So average tariffs on imports into US is 2.3%. You're saying that goes up to what in your base case?
So we don't have that. We do not have a baseline where we say, we just had a baseline which says that only China will be targeted.
Okay.
The risk is it's going to be far more extreme than that.
Okay. What is the, so I'm just trying to see what's the feed through to inflation. And then...
on the US?
On
the rest of the world?
US inflation. And
So
then what happens to,
the interest rates
in the US?
Right. So you're asking a very difficult question. Okay, let's start with the first question, inflation. In order to minimize the impact of inflation, chances are that whatever increase they have, this universal tariff increase, is not going to be uniform across all goods. Consumer goods, the tariff will be less. Intermediate goods, the tariffs will be much higher. So in order to get, let's say, a 10% average effective rate. That minimizes your impact on inflation. So that's the way we think it will be played out, if indeed you're getting a universal tariff. It's not going to be uniform 10% on everything. Consumer goods less, intermediate goods more. So I think that's such a move can, at least in the first rounds, before the second round effects take place, that can minimize or limit the amount of increase on inflation in the US.
So pragmatic in that sense, Jahangir, at least in terms of effects on inflation, US inflation.
Right.
So just to complete that point, what does the Fed do then? Rate cuts, bets have disappeared. Is there a chance that there could be a rate hike, or you think that's extremely unlikely? One of your sort of.
So we think the rate hike is extremely unlikely. You really need the core PCE to move above 3 and remain there and things like that, which looks unlikely.
Quickly, a move on India, because everyone's trying to second guess now what the RBI will do here, given the external environment and our local issues. I mean, we had an inflation print that came down, CPI inflation, but look at what crude is doing. It raced away 5% thanks to these sanctions. So just quickly, your expectations on the US 10-year as well as the path ahead for the RBI.
So on the US 10-year, I think the business cycle part of it has already been priced in, i.e. that the Fed is only going to go at best to 4, and that you're not really going to get a rate cut more than 2 rate cuts for the rest of the year. I think that part has been priced in. What has not been priced in is the impact of tariff on inflation, the impact on immigration on inflation, and more importantly, the size of the tax cuts and therefore the size of the fiscal deficit. Those haven't been priced. So I think that if you have negative shocks on those 3 things, you could see the 10-year move up, and 10-year has been moving up.
Yeah, got it.
So that's on the 10-year. On India, look, very quickly, we have been arguing about a rate cut for a long time, given that we had expected the growth to slow down significantly, inflation to come down. Core inflation already has been languishing for a very long time. So there is no reason not to have a rate cut. We do have a rate cut in February, and we're still sticking with that there will be a rate cut in February. Obviously, if there is a turmoil in the FX market, then the rate cut gets pushed off. So far, I don't think a 3% depreciation is enough to take away that rate cut, but a depreciation higher than that, possibly the February rate cut gets pushed up, but we do have a rate cut in February. In fact, we have 100 basis points of rate cut in 2025 price for the RBI.
All right, Jahangir, got that. Interesting times and complex times that we live in today. Let's see how this plays out once the inauguration is over and done. Thank you very much for joining us on the show today. With that, it's a wrap on this special.